One of your investing rules is check stock prices weekly or monthly. And I read you've got your Bloomberg in a different office or in a low and uncomfortable table.
Mm-hmm.
And you can go weeks without checking it at all. I find this slightly
Bizarre.
odd, right? Because, well, to me, the stock price is the most important signal.
Yeah.
Right? And if you don't check your stock prices, how do you know if something's happened? I mean, how do you know that if a stock has fallen 10%, you need to know that because you need to be able to investigate it. Or if a stock, even something you don't own, something that you're interested in has fallen 10%, but that might be a better opportunity than something you own. So I sat there with a Bloomberg screen and a watch list, and it was there, one of 2 or 3 screens, depending on which place I was at, that was on all the time. I wasn't watching it the minute-to-minute ticks, but I just needed to know if something had happened. I mean, and I had a dealing desk. If something bad happened, they would be on me. But
my experience has been that when something happens, I do find out.
But how?
I get emails in my inbox. I get analyses from somebody. The news kind of finds me in a certain way, and so somebody will, and I think that maybe it's being a slightly more prominent investor. Perhaps I put up on my not every single company that my fund invests in, but I've put up on LinkedIn some of the companies I'm invested in. I just add as if it's a job description. I say investor in, and then people think that I'm some private big investor and I'm just a portfolio investor. So I think that the feedback does come to me that way. I also think that it's really, really important in terms of what I'm invested in. There are some businesses that change by the second, or where you're in a biotech firm and they either get approval or they don't get approval. But there are some businesses which are kind of glacial in terms of the pace of change. And so if you decide that you're not going to be checking stock prices, you're forced into these businesses which are absolutely glacial. A question that just stuck with me that came up in one of these interviews that I printed out and read was, I think it was Charlie Munger asking, not Ted Wexler, but the other lieutenant, which of the members of the S&P 500 do you think will be a better business in 5 years? And I think that, that question just struck with me because it's such a powerful question. And if you just stick around businesses that you feel, that you believe, you have some confidence that they will be better businesses in 5 years, you only restrict yourself to investing in those possibly if you get a good price. And it does mean that anything where things are happening on a monthly, weekly, half-annual basis are just outside of the... And there's a book by, his last name is Pulak, and Monish sent it to me recently. Forgive me for not remembering the full name. But he talks... Pardon?
We'll look it up. We'll put it in the show notes.
Yeah, and he talks about the evolution and how we're looking... So there's this idea, I don't know a lot about evolution, and he goes into some analysis of it, of how at first Darwin kind of expected there to be sort of like a gradual drift in species from one thing to another. And as I understand it, and I hope I haven't gotten the idea completely wrong, the kind of the scientific consensus is that if evolution is punctuated, there are long periods of very little change, then change can happen unbelievably quickly. And so, in a certain way, I think that his point is that why not look for businesses which are in these periods of stasis, where they're good businesses, but there's very, very little change for a very long time. And, it really bugs me because every time I figure one of these things out, or a book like Pulak's helps me to figure something out, I realize Warren already knows it, because I think that probably Coca-Cola is an exemplary example of that, where it's kind of in stasis. It's been a great business for a very, very long time, continues to be a great business. So I think that here's an interesting perspective for you, Steve, is that if you're a biotech investor and Guy Spier is saying, don't check the stock price, you're going to have your head handed to. If you're a biotech investor or all sorts of other industries, definitely check the stock price. But so you have to restrict yourself to certain kind of like very glacially changing businesses. I think that probably I've had my head handed to me because I thought a business was glacial and it wasn't, or I thought that it was definitely something that would be better in 5 years and it wasn't. And yeah, so
I mean, because, I mean, the stock market gives you a report every day, which is quite useful, I find. And
yeah,
and yeah, I mean, I understand that if you're having a very slow moving set of businesses, the problem with that is, of course, we're in a very fast changing world, and it might be a glacial change, and then all of a sudden something comes from left field that you didn't know about, expect, or whatever, and then you
have to pay attention.
Yeah.
And I would say, I mean, it makes me think of a comment that Jeff Bezos made: in a world where everything is changing, look for the things that aren't changing. And, people like cheap stuff conveniently delivered. It would be one of the things that seems like Jeff Bezos found that wasn't changing. It's also it's a decision about how to live your life. So I think that maybe quite likely I've given up returns that I could have had if I'd been willing to look at a broader set of things where things were changing more rapidly. And I've chosen that I don't want to live that life because it's kind of a stressful life. I also think that there's a statement that Nassim Taleb has made. He made this comment. Well, it's not a comment. It's just if you have a volatile market that's up, I think that historically the market is up, maybe it's 7 years out of 10. I'm not sure. But if you look at that, the volatility that creates that, or the price movement that creates that, and you look at shorter and shorter time periods, the shorter the time period, the less likely the probability is that it will be up in that particular time period. And so you look at the market over a broad sweep of 20-year periods, and there's very few periods where it's not up. And you shorten it, and if you look at on day by day or 5 minute time section by 5 minute time section, it goes to 50.xx 1% of the time it's up, and 49 point ... And if you have a asymmetry between what you feel when you see a gain, what you feel when you get a loss, certainly that says check the stock price less frequently. And then what I would put to you, and I find this very, very hard, is that so you see there's a piece of news, something's happened, there's price action, and then I have to decide whether that's significant or not. And I don't think that I'm capable of being rational very often in those kinds of circumstances, because I believe that I've seen far too many times people, they don't believe that the price action is instructing the analysis, but that is actually what's happening. And too many times I've seen where I just ignore that. The market turns around and suddenly there's a different world, and actually all the analysis that people had X weeks ago is completely turned on its head. And so the market plays really strange games with you, and it's really dangerous, I think. I understand that the stock price contains an enormous amount of information in it, but it's really dangerous for me to look at it regularly. And I think that I'm trying to create an environment. I really do believe this. I mean, I think that there are some people who maybe are more rational and are faster and quicker and better with the analysis. And I don't want to rely on that for myself. I want to actually rely on being the dumbest investor in the room and create an environment where the dumbest investor can actually win and succeed. I'd like to believe that I'm intelligent, but I don't want to make my living off being intelligent. And I think there's an extraordinary mistake that some of the best analysts make, and some of the smartest friends that I have, is that they naturally gravitate towards situations where it's too hard for less smart people to figure out, but they're, with their prodigious and analytical capabilities and capacity to think through scenarios, they love that. But actually, I'd like to be able to solve math problems. I've been playing a lot of chess recently. I'd like to be better at chess, but I'd like to divert or use that ability in that direction. And if you take Warren Buffett seriously, invest in a business that any fool can run, because sooner or later one will. Well, one day I might have dementia and I'd like to look smart in my job. So create that environment around me.
No, that's a great thing to take away, because the overly complex stuff people do love, and it never works. I mean, if it's that complicated, the stock market will never work it out. So, I always think exactly the same. If it's a really complicated story, I'm not going to invest in it, because you've got multiple ways of being wrong, first of all. And second of all, how do you know that when's the stock market going to work this out? And
there's multiple ways of being wrong, but you're still drawn into it, and you're not even aware of the multiple ways it might be wrong. And that, just going back to the analyst idea. So if you're an analyst, I find Value Investors Club a really, really interesting website, because I think that many of the smartest analysts are on Value Investing Club. But if you're going to display your extraordinary talents as an analyst, you're not going to be able to do it with a really simple idea that works well. I remember, and it's just I've mentioned this before, but the way I met Nick Sleep is that I'm reading about Tom Russo, and I see that he owns shares of this company, Weetabix. And I'm all over that. I know the Weetabix brand, and it didn't take much market research to discover they had a 50% market share. I went and visited, it was a family-owned business at the time, AIM traded. I went and visited them up somewhere outside in Cambridgeshire. And, the guy knew that I was an investor, but I went in, it's the only people that would meet with you were quality control people, and they were willing to meet with people who consume the brand on the quality control. But he knew I was an investor, and he took me around and he showed me. But the write-up was like one paragraph. This is a brand, a cereal brand that is beloved in the UK. It has 50% market share. There's no way that anybody can compete with them. It's run like a family business. It has no debt and trades at 4 times earnings. Next question. That's it. There's nothing else to say. How's an analyst going to demonstrate how knowledgeable he or she is with that? So they get attracted to really, really complicated things. And that's a danger about having an analyst. They'll kind of want to show you how smart they are. And sooner or later, you might buy what they're showing you. It's a the investing world is an extremely strange world, because whatever's been figured out, coming here, Steve, I was thinking about how little of what you teach is actually used by analysts today, or what you used to teach. You may have updated your teaching in this way. Quality of earnings, forensically looking at the notes to the company's accounts to try and understand which way they're biased. Are they aggressive on depreciation? Are they not aggressive? Are they, but that's not what passes for analysis these days. And in a certain way, I think we perhaps went through a period where everybody was doing that. And when everybody's doing that, and when there's a lot of knowledge in that area, and everybody's read security analysis, then the return on that goes down. And so I'm pretty sure that we'll come back. But
well, the good news is that nobody's been doing that for the last 10 years, right? Because it hasn't worked. Right? Because understanding, that companies are becoming more aggressive made no difference to the stock price. And it's only now, as we enter the new regime, that this will become important again.
Not only did it make no difference to the stock price, it probably actually hurt the stock price.
Well, I mean, it hurt your performance, because you're paying attention to all this stuff that I worry about. And you weren't following Chamath into the junk that he was floating. Your performance suffered. And so it's only now that, real investors will come to the fore, I reckon. And I, my belief is that, and it'd be interesting to know if you you might not even have a view, but it's my belief we've had sort of 40 years of falling rates. And I've been doing this presentation to various investment conferences saying it's not just the 40 years of falling rates, everything else has been a tailwind, demographics, globalization, cheap imports from China, inflation, everything's going into reverse. So, your comment that, in most 20-year periods, the stock market's gone up. Well, we might be in a period in which that won't be true. And that, of course, makes things very much different. And therefore, people will actually have to probably trade more, because you have to buy things and see their value recognized and then move on to the next thing. And you have to look at balance sheets. And are companies really as high quality as they appear? I don't know. Do you think about any of that stuff, or you're all bottom up? You don't care about the macro.
I mean, I had the hardest time with, I mean, and not so much macro, but these new ways of looking at what the intrinsic value of the company is. And the time when it just really, really struck me was when a friend took me through his valuation model for Salesforce. And, you know, I saw a company that was not very profitable that dumped a huge amount of expenditure into marketing. And I've really enjoyed going to a Dreamforce event. A Dreamforce event that I went to in New York once, this kind of like amazing event with all sorts of enrichment opportunities. Of course, so enormous amounts of marketing. And in order to sort of come to a conclusion that this company was cheap, you had to kind of make assumptions about how, on the one hand, the churn of the customers, so the natural turnover of the customers once they've been acquired, was going to be below a certain level, so that the customers you acquired through this enormous marketing expenditure had a lifetime value, which was sort of like the cash flows from that customer would sort of like, you could project them out 20 years. And you also had to have the assumption that at some point you switch off the marketing spigot. And so there's enormous cash flows to develop. And if you look at the history of Amazon, you know, I mean, you know, I don't know how many times this has worked, but Jeff Bezos realizes that he can make enormous investments today, take the profitability of the business down to very low zero or even negative, and that they are going to develop these extremely high cash flows 10, 15 years down the line. And that actually happened. And now you've got a whole bunch of people looking for that all over the place. And so, you know, I mean, what I wrote about, and I wanted to find that myself. I so wanted to find it. And I just couldn't find one that made sense for me with the numbers. I think that, but to your point, I think that what happened to me in the last period is that I think that if you kind of had some kind of training in accounting, looking at the inventories, looking at where the inventories are, how much capital is invested in the distribution channels, how much of the distribution channel, I mean, so many of those businesses. So I actually looked at one recently that I'm happy to talk about, a company called Mastercraft, which makes speedboats for water skiing. And it's a relatively small business, market cap about $500 million. And basically, if you want to do water skiing right, I believe you have a choice of two brands. You have Mastercraft or Chris-Craft, are only the really two brands. And even there, Mastercraft is the better brand for, you know, very, very people who really want to do water skiing right as a professional sport. And, you know, then you're kind of looking at how much product do they have in inventory, how much of the product is finished product, how much capital is really invested there, how much of all of those questions. Those are really hard businesses. There, you really do want to do that analysis. And every now and then you might come across a business where they've been incredibly conservative in the way they've reported all of that stuff. But that's hard work. And I found myself for example, in the credit rating business, you don't have that. In the stock exchange business, you don't have that because they're kind of like, you have an expense center and you have cash come in, basically. There's none of that stuff. And so I think that dyed-in-the-wool financial analysts and accounting analysts have to accept is that the proportion of businesses that have that kind of classic model of manufacturer's model with capital invested in the inventories and the distribution system is not the only model around. It is true, though, that if we look at Berkshire Hathaway, I think it's true to say that most of their operating businesses do have that model. And it's an interesting question why. And I think that part of the question why is that those moats are easier to analyze, and they may ultimately be more durable, even if they're less exciting businesses to look at. It's fun to dive into that with you a little bit because I think you have an enormous amount of expertise there. And I think it's still great stuff to teach. And I think that many analysts, they probably haven't done it ever.